So the key in investing is to recognize two things. One, we're going to make a lot of mistakes. Two, this is a very forgiving business. You can be wrong even 98% of the time, still come out smelling really nice. And three, that is only going to happen if you are able to buy businesses with great economics at reasonable valuations and then hang on to them forever. So when they get fully priced, they don't get sold. When they get overpriced, they don't get sold. Yeah. And I've made some good progress on the 50 businesses. I think it's up to close to 20 so far. And I have to pull it up, maybe like 17 or 18 or something like that, which is I'm on track because basically I'm behind if I'm not at least one per week, so I'm very pleased with that. And of course, when I make a trip, like I made a trip to Turkey, I see all these new companies. So I get a lot done during a week like that. But yeah, I mean, I think that one of the things I am excited about is it's kind of a new way of me looking at things is what I call the circle the wagons approach to investing. And, this year, for example, Buffett in his letter mentioned that Berkshire has a few truly extraordinary businesses, many pretty good businesses, and a very large number of mediocre or below average businesses. And he also mentioned that in 58 years, it's really been 12 decisions that have created most of the great outcome for Berkshire. And most of the other decisions have just been at best so so. So if you look at something like Berkshire Hathaway over 58 years, Warren has bought more than 80 companies in that period. He's probably made at least 10 key hires and probably bought at least 210 stocks over that period. So collectively, well over 300 decisions. And when he says that 12 stand out, it's like 1 in 25. It's like a 4% hit rate for someone as great as Warren Buffett. And, Charlie Munger said many times if you took our top 15 decisions and took them out, our record would be useless. We actually see this particular phenomena of, this 4% play out over and over. So, for example, if you look at the Nifty 50, in the early 70s, which was very popular by the 50 bluest chip stocks, and don't worry about the valuation, kind of set it and forget it. There is some controversy whether Walmart was part of the Nifty 50 or not. If you assume that Walmart is part of the Nifty 50, we'll take two cases here, but let's say you assume Walmart is part of the Nifty 50, and you assume that it has a 2% weight in the Nifty 50 because there are 50 stocks. Each one has a 2% weight. And you assume that the other 49 stocks go to zero. They just get wiped out. And you assume that you bought Walmart at the IPO in 1970 and you held it till today. The Nifty 50 with 49 out of 50 gone to zero would have ended up with something like a 13.3% annualized return. And the S&P is 10 and change, 10.3% or something. So with just 2% of the portfolio surviving and being there for the entire 52-year period, you still significantly outperform the S&P. And of course, 49 of the other names didn't go to zero. They were like McDonald's and Coke and Procter and Gamble. There were a lot of good companies. There were some bad companies like, Polaroid and Xerox and Kodak and Burroughs, and a lot of these companies basically went to zero. But you can just see that the one decision whether Walmart is part of the group and whether you keep it or not has such a outsized impact. Now, if you take the other case, which is that let's assume that Walmart is not part of the Nifty 50, and you assume that you invest in the Nifty 50 at the all-time high in 1972, just before the big crash of 73, 74, and you run it till today. what you find is that the annualized return is 10.2% annualized, and the S&P is 10.3%. So even with buying at ridiculous valuations, but just holding them. Of course, what happened in 73, 74 is the Nifty 50 went down 50%. Nobody was in the Nifty 50 by 1975, that everyone exited. But if they had held on, and if they had held on till today, they would pretty much be toe to toe with the S&P. It's not that much of a difference. And this lesson again plays out where we had this great investor in India who passed away last year, Rakesh Jhunjhunwala. And Rakesh Jhunjhunwala never managed money professionally. He was an individual investor. Maybe close to the end of his life, he was starting a business, but basically it was all passive investing. And he started with $400 when he was 25 years old. And at 62, when he passed away, it was 5.8 billion. In 2003, Rakesh put 4% of his portfolio into a company in India called Titan Industries. And it was a $3.4 million bet on Titan. He had about $85 million in total assets at that time. So he invested 3.4 million. If you, again, like the Nifty, take everything to zero that he had in 2003, except for Titan, and he owned little over 5% of Titan. You run it till when he passed away. Now his widow has kept Titan, so it's still compounding. It became 1.4 billion, excluding dividends. If you reinvest the dividends, it's even higher. So 3.4 million was a 400x return. And so even if you took everything else to zero, he'd still have 1.4 billion. And these are not venture investments, right? I mean, when Buffett buys Coke or sees candy, these aren't early stage like Sequoia making a bet on Amazon when it's an early stage business. These are mature businesses with a lot of history. And we see the same thing with Nick Sleep with Amazon. I mean, if you pull Amazon out of the equation, Nick Sleep's record isn't that great. And when you put it in, it's an exceptional record. And then, of course, the most extreme case of all of this is Naspers in South Africa. So, Naspers in 2001, it's almost a 100-year-old newspaper company. That's how it started about 100 years ago. In 2001, they have a market cap of about $500 million. They put $32 million into Tencent, and they get a 46% stake in Tencent. And the most surprising thing about the Naspers Tencent adventure is they basically never sell. They sold a little bit of the IPO, but they still own 36% of the company in 2018. And in 2018, their stake was worth 170 billion. And in 2021, at the peak of Tencent, their stake was worth 270 billion. So here's a, sleepy old, media company in South Africa. They suddenly start seeing some Chinese company become 99% or even more than 99% of their total assets. And they don't trim it and they don't hedge it. They just keep it. And they end up with an, astronomical annualized return over the last 20 years. And so if you look at the 10-cent bet, it was 6%, approximately 6% of the value of Naspers at that time. And Naspers made, hundreds of bets. Everything else really didn't matter. There were only two things that mattered: buying Tencent, and more importantly, not selling Tencent. So the circle the wagons concept comes from the 19th century on the American frontier. So when the pioneers and the settlers were moving west to, stake out and take over land and start farming it and so on, these wagons used to get attacked by the American Indians. And the defensive posture they took to defend against the Indians was to circle the wagons, which means, you put everything, your crown jewels in the center of the circle, and then you fight and you try to protect the center. It's a similar concept in investing. With the Nifty 50 with Walmart, you really need to not touch it. It only works if you don't touch it. Similarly, with See's Candy and American Express and Coke for Berkshire, all of these, hiring Ajit Jain and so on, you need the long runway. And Naspers needs the very long runway with Tencent. And so the key in investing is to recognize two things. One, we're going to make a lot of mistakes. Two, this is a very forgiving business. You can be wrong even 98% of the time, still come out smelling really nice. And three, that is only going to happen if you are able to buy businesses with great economics at reasonable valuations and then hang on to them forever. So when they get fully priced, they don't get sold. When they get overpriced, they don't get sold. It's only possibly when they get completely ridiculously, egregiously overpriced that you can consider selling. And so this framework of circle the wagons is very fundamental. I think it's very hard to beat the market if you don't have this framework, because you're going to be cutting the flowers and watering the weeds. And what we need to do is make sure we don't cut the flowers. And it really doesn't matter whether you water the weeds or not, but the important thing is you just don't cut the flowers. It's okay if you want to water the weeds.